Finance has its own vocabulary. If you want to understand how businesses are analyzed, valued, or bought and sold, you need to know the language. In this video, we'll cover 5 key acquisition terms. They're the building blocks of deal making, and once you understand them, financial conversations will start to make a lot more sense. Free cash flow is one of the most important numbers in business analysis. It represents the cash left over after a company pays all of its operating expenses and its capital expenditures. In other words, it's the money available after paying for things like rent, salaries, and also long-term investments such as equipment or building improvements. The formula is operating cash flow minus capital expenditures equals free cash flow. Analysts love this number because it shows how much cash a company really generates. Cash that can be used to pay dividends, reduce debt, or reinvest in growth. Net profit, also known as net income, is what most people think of when they hear profit. It's the total earnings after subtracting all costs from revenue. That includes cost of goods sold, depreciation, interest, taxes, and every other expense. Net profit is sometimes called the bottom line because it's usually the last figure on an income statement. It tells you if a company is truly profitable once everything has been accounted for. Working capital is all about liquidity, the ability of a business to handle its short-term obligations. It's calculated as current assets minus current liabilities. Current assets typically include cash, accounts receivable, money owed by customers, and inventory. Current liabilities include accounts payable, money owed to suppliers, wages payable, and other short-term debts. If working capital is positive, the company can cover its day-to-day operations smoothly. If it's negative, the company may struggle to meet obligations without borrowing. EBITDA is one of the most widely used metrics in finance and deal-making. It stands for earnings before interest, taxes, depreciation, and amortization. EBITDA focuses on a company's operating performance by stripping out financing costs, tax policies, and non-cash expenses. Why is it important? Because EBITDA provides a clearer view of the company's true operating profit, the kind of performance that investors and buyers look at when comparing businesses across industries. PFN, or net financial position, measures a company's debt position once cash and cash equivalents are taken into account. The formula is financial debt, cash with net financial position. If PFN is positive, it means the company has more debt than cash. If it's negative, the company actually holds more cash than debt, a stronger financial position. Analysts use PFN to quickly understand how leveraged a company is and whether it has the financial flexibility to handle new investments or acquisitions. Why these terms matter? Individually, each of these terms gives you one piece of the puzzle. Together, they form the foundation of financial analysis and deal-making. Free cash flow shows how much cash a business truly generates. Net profit reveals the bottom line. Working capital measures liquidity. EBITDA captures operating performance. PFN, net financial position, shows the balance between debt and cash. Whether you're studying finance, analyzing a company, or just trying to follow business news, knowing these terms helps you understand how decisions are made in the world of acquisitions.